Hello, and welcome to the Wade Borth Podcast. I'm your host, Wade Borth, and in every episode, my goal is to get you to think differently about how money works and ultimately to empower you to take control of your money and your personal financing system. Welcome back to the Wade Borth Podcast. Again, in continuation of our series, Tarisa Shelton is visiting with us today, and we are having a great fireside chat with Tarisa, talking about infinite banking, her journey, how it's impacted her life and really just changed her financial life, but more importantly, changed her personal life. Really the freedom and confidence to go do what you want to do when you control that banking function in your life and you have a better understanding and better control of a lot of things that somebody else maybe said yes or no to in the past. I use this line a lot of times. It said, if you have to rely on a banker or somebody else to give you a thumbs up or thumbs down on a project you want to do, then you're not really running your business. Somebody else has control of your business. So think about that from the infinite banking standpoint, because really what we're trying to teach people isn't about returns or anything else. It's about control and freedom. The control and freedom that you're looking for in your life, because so many other people are trying to take it from you, right? Think about your investment advisor or somebody else that's out there. They're the director in your movie, right? In your family, in your life movie. Put yourself in that seat. Why aren't you in control? Why aren't you the one that's saying out there, I'm going to go educate myself and I'm going to get a much better return because it's a return on me versus a return on some portfolio that they're taking a piece of every day. So it is so powerful to have this conversation with you. So thank you so much, Tarisa, for joining us again.
Thanks for having me, Wade. I'm always excited when I get to have a great conversation with you. So thanks for making my day.
You bet. So in our previous segments, we talked about a number of different things, right? When to get started, why does it make a difference? Your backstory, Tarisa. I would encourage people to go back and listen to those previous podcasts because, like I said before, there are a ton of gems that you shared with us. You sprinkled us with just so much information and just gems that we can use for the next 50 years in our lives. So thank you for that. So today we're going to talk a little bit more. Let's talk about the nitty gritty a little bit. How does that sound? Some of the things you hear, some of the objections that you come across, some of the things you just want to share because it was something that was on your mind when you first got started in your journey. Because again, everybody's in a different place. And so let's maybe start there a little bit and kind of just open up and say, what are some of the things that you hear? What would you like to share with people just off the top of your head?
Okay. So is this when I'm going back to the first part of my journey or as of where I'm at right now today?
Let's start the first part of your journey because I think it's just interesting because we'll see the progression of where you were at when you first started researching it and what kind of questions did you have, right? And here's one that I hear from clients quite a bit. Is this safer than the bank? That's one I love when they ask me that question.
I'm like, let's get into the Wade answer because I also would love to hear how you respond to that.
Well, so, I look at it and say, well, of course it is. I mean, you look at where do banks go for safety? What does $25 billion, let me repeat that number, $25 billion mean to you? That's the amount of money that Chase keeps in properly structured whole life insurance. This is where they go for safety, right? So if you think the banks are safe, where do the safe banks go for safety? They go to insurance companies. So again, what do I have to quantify the fact that I believe it's that this is a safe place to hold your money? How many people have ever been denied a claim because an insurance company's gone bankrupt? Nobody. That's a powerful statement to make, and you can say it boldly, right? Where do banks go and hold their money? They don't go to other banks. They go to insurance companies, right? I mean, don't take my word for it. Just follow the money, right? The old adage is follow the money. So I don't know how you answer that question, but.
Yeah, similar to you, what I basically say is, let me ask you this question. If you put your money in an environment and then they can loan out 10 times what you actually put in, and they do that for every single customer, and everyone wants to take out their money all at the same time, does that sound like a safe situation?
Absolutely not.
And that's essentially how banks operate. And so many people don't know that. You're operating under the premise that hopefully nobody takes out all of their deposits all at once. And my question to you is, does that seem like a safe environment for you to put a large majority of your liquid capital? And if you look at a lot of countries, and I think this is so interesting when you look at the big picture, is the first thing that happens when a country starts to go under, everyone is running to the bank. And guess what is like one of the first places to close?
The banks.
Absolutely, because they have an understanding that they literally can't afford to pay everyone out all at once. Whereas life insurance companies, if you think about it, They are in business for hundreds of years. They are legally obligated to fulfill the claim that they pay out for the death benefit. So would you rather have your money in a place where if you put in $1, they can loan out 10, or if you put in $1, they're thinking about how can I pay this death benefit claim for every single policy holder that has a policy at our institution tomorrow, in 10 years, in 100 years, in hundreds of years. That to me sounds like a much better place for me to put my saved money.
Yeah. Yeah, and it's interesting. That is so true, right? I heard a chief financial officer for a mutual company, and he made the point, he says, and we'll talk about this a little bit because I think this is really important, the difference between a mutual and a stock insurance company. But he made the point, he says, we don't really get too concerned about the next quarterly conference calls for shareholders because they don't have them, right? He says, we worry about the next quarter century. And I think that perspective puts them in such a different light than companies that are having to find immediate returns. Because what risk are they willing to take in order to get that immediate higher return? And when things are good, nobody seems to care. But when things are bad, everybody seems to care. And so that's why I always tell people, when times are bad, you can go back to 2008. Who had all the money for the bailout? I mean, who got the bailouts were the banks. Who provided stability to the economy? All the insurance companies.
Right. I think about this all the time. Like, short-term thinking gives you short-term and long-term problems. Long-term thinking gives you long-term solutions. And that's how I view banks versus mutually owned life insurance companies, is banks are operating under the premise of how can we increase profitability so that we can impress shareholders, like you said, quarterly? How can we prop this up, essentially? Whereas life insurance companies are saying, hey, how can we make sure that when we're building these things out, when we're making these decisions, that this can stand the test of time?
Yeah, it is about thinking long range. I mean, that's one of the things that Nelson, that was one of his key points, right? Think long term. But and this is the part that I think there's a huge disconnect, and maybe we can get into it a little bit. People are looking at insurance companies and they're trying to find the short term gotcha. Like, well, this company is fractionally much better than this company. And they're all trying to look for that short term gotcha. But they've lost the purpose of, we got to think long term. When I say think long term, I'm thinking I want to free my family from the bondage of being held down by somebody else, by the banks, right? Them giving me a thumbs up or thumbs down if I want to do anything. To now I want to it's going to benefit me, but more importantly, it's going to benefit my son. And hopefully his son or daughter after that, or whatever it might be, right? This is generational. And when you start thinking long term, you really change. You don't look at those little blips, right? I always kind of say, if you ever watch the Kentucky Derby, does a lead horse out of the pack at the Kentucky Derby ever win the race? I'm going to say hardly ever. Right?
I'm like, I don't know if I've ever watched that, but I'll guess no.
It was just recently on. When this airs, it'll probably be the Preakness or whatever. But my point being is that the lead horse is rarely ever the lead horse the whole time. So don't get caught with what I call a TikTok mindset. It's a flash. It's here. It looks great. But what are we trying to do from a strategic point, from a long-term strategic point? And I just want the listeners to think about that for a little bit, because again, we all want to think, my company's better than this company. I'm like, it really has nothing. Well, it has a lot to do with the company, but more importantly, it has more to do with you than the company. But we have to think long-term. And those partners of ours, those mutual insurance companies, have been around for 150 plus years. And they've been around. They've been very strong for 150 plus years. All the things that have gone bad, you think about that, right? The recessions of the 1890s, the Great Depressions of the 30s, the World War I, World War II, the Great Recession, .com. I mean, all that stuff went on, and these insurance companies just chug along, man. They're like, yep. What was the adage that a friend of ours at One America said? You're going to hate conservatism until you love it. Until
you love it. Yeah, I love that phrase.
I'm sorry, I just got down on a little bit of a rant, but it's so important to think long-term. And if we're not thinking long-term solutions, we're creating long-term problems.
Absolutely. Well, and I think too, like how I think about companies, like you said, I think sometimes people are like, is it this company or this company? And there is a great handful of mutual insurance carriers that you can do the process of infinite banking with. And Nelson gives the example of two different vehicles. If you have two different people, the same vehicle, and depending on how they maintenance the car, depending on how they drive it, the longevity of that vehicle is entirely dependent on the person who is in the driver's seat. And that's what I tell people about the policy. You are the person that is going to dictate how well this system does for you, because you have the ultimate freedom and the ultimate control. And as a result of that, you honestly have the ultimate responsibility to be a good steward of that system.
See, right there's that nugget that everybody, if they didn't catch that, I mean, they could just ignore the rest of the podcast for that little bit. But don't ignore the rest of the podcast, because there's a lot more good stuff ready to come. But right there, right? Who's driving it? And again, you take the same exact vehicle, and one's junk after 5 years and one's pristine condition. It's about the person that owns it and runs it. That's the key, right? It's you. It's all really on your shoulders. That's the powerful message. Because again, a product is a product. And that's what I think people get lost. They think buying a policy is going to solve their problem. And if they don't have Parkinson's law, if you haven't read Nelson Nash's book, that's where we're coming from, a lot of these references, Becoming Your Own Banker, I'd encourage you to read that. I'd encourage you to go out to factandfinancial.com, watch the videos that they have in the resource pages, because it talks a lot about that. But it is just one of those things where the product is a product. And it's like you could have the greatest set of carpentry tools, but if you have no idea how to use it, then you can't build a house. And if you do build a house, I don't know that you'd want to live in it.
Yes,
you have to become a master in your craft. And the only way you can become a master in your craft is become an apprentice. And what I mean by becoming an apprentice, find somebody like Tarisa, find somebody like me, find a practitioner that understands what they're doing. Have them show you their system. What are they doing? And that's how you can tell if you have a true craftsman on your hands. Is what are they doing? How are they treating their system? And then what can they teach you is to bring you along. So I want to go back to a couple things you said. Tell me a little bit about your thoughts about mutual insurance companies. I have some thoughts, but I want to hear your thoughts.
I actually think that there's so much to be said in the name, mutual insurance companies. Usually something that is mutual is because there is a win-win relationship for all of the parties involved. Whereas you don't necessarily have that relationship when you deposit money at a bank. They're very grateful for the inventory that you supply them that they're then going to sell, right? So there's a gratitude there in a form of 0.01% on your savings account. That's how grateful we are for it. But mutual insurance companies are fantastic because they are not beholden to propping up numbers to impress shareholders. They are looking at the ownership of this whole pie, and policyholders are a large part of that. So really they're looking at it and they're saying, how can we be diligent and responsible in the resources that we have to make sure that we honor our customers and also our partners in business? So I can't think of a better relationship to have in terms of where you store your money, because they're always going to have your best interest at heart, because they realize that I think about it a lot like reputation. You know, they want to have a reputation that precedes the time that we're in now by hundreds of years down the line. And how can they make sure that they put their best interest at heart for the policyholders that they have there? So that's how I think about it. It's a little bit like high level and not super specific, but
no, that's good stuff. I mean, it is a great perspective, because a lot of people, some people I know, however you want to phrase it, think that there's no difference between XYZ mutual company. Again, one of the companies we love is One America. It's a mutually owned company. Or let's pick on AIG, for example, a stock company that's out there. No, people don't recognize the huge difference that's between them, right? And you think about, going back to your comment about a mutual insurance company, this is a contract between like-minded people. That's what starts and keeps the company going, is that we're not getting in contract. Again, getting into a contract is a whole lot different than putting your money into a fund, by the way. It is contract with rights and responsibilities on the insurance company, rights on our part as policyholders. So we're getting into a contract with a mutually owned insurance company, which is just with like-minded people for the benefit of its policyholders. That's really what a mutual insurance company is. And then they're going to take that money and they're going to be good stewards of that money. And this is the part that I try to explain to people. The difference between a stock company now and a mutual company is that if a stock company does something to you, Tarisa, and quotes and quotes takes you to the cleaners because of something they did, right? They take you to the cleaners, right? And you're mad about it. The profitability of that action goes to the stockholders. Let's take a look at a mutual company. What's their incentive to take you to the cleaners? So they get extra profit. What do they have to do by law? They have to bring it back in the form of dividends, back to you, the policyholders. So there's no incentive to stick it to you. as it were.
The mentality is if I win, you win.
100%. Yeah, exactly. And now because of that, the reason why they don't want to stick it to you is because in essence, you are the owner of that company, in a mutual company. Who's the owner of a stock company? Wall Street. And so when people are talking about, I'm going to use this product, and the one we run into, and I try not to really get down the weeds about it, is I'm going to use an IUL product. Okay. If you read Nelson's book, he specifically says, don't do that. But if you think about it, take a step back, are you an owner of that company or are you a customer of that company? And which one would you rather be?
Which character at play is making the most money? Nelson
exactly
encourages us to think about that premise.
Yeah. So as I look at it, like I said, the reason I stick with mutual companies is just because of that. You want to buy policies, you want to be interactive with a company that you own and it's run for your benefit versus buying a product from a company that you don't own and you're just a customer of.
Absolutely. Because like you said, they don't have as much incentive to take care of you.
Yeah. I mean, they're still going to want to take care of you, but if they do happen to do something to increase their profits and you lose, somebody else is going to win. Where like I said, we're a mutual company that's ran for your benefit. So there's no incentive to do that. And again, it's the insurance industry, the life insurance industry as a whole is a great industry. I mean, I've been a part of it for a lot of years. But yeah, I know there's a distinct difference between the two different types of companies that are out there. And I would say the majority of the people just don't recognize what the difference is. And I think sometimes we get wooed by the shiny object sometimes because they put a bunch of bells and whistles on. And I always have to say, if you had to put that many bells and whistles on something to make it look good, how ugly is it really?
Oh, that's a good one. How ugly is it really? Yeah, it doesn't need to be complicated. What you see is what you get sort of situation. I feel like, especially when it comes to knowing that there's guarantees. Wade, I love how you talk about this, and I think this is an important point to bring up. Can you talk about the buy and sell agreement that you have with, or how you look at that in terms of mutual insurance companies? Like when someone starts a policy, you have this analogy that I love, that when someone starts a policy, they're essentially, if they look at like year 10 or year 20, and the company, for whatever reason, does terribly, do you know what I'm talking about? Here's the least amount you could.
Yeah. So we probably do a whole podcast on this, but I'll give you the bridge version of this. This is the crazy part because I hear clients, I've had clients say, so they'll look at an illustration and say, oh, I could do better. I could get a better return. I'll make the point compared to what? Right? A mutual fund is out there. And again, typically it's against a mutual fund. And I'm not going to pick any particular one. But I'll say, hey, I love to have this conversation with clients because when I look at my policy, I know I already have an exit strategy. If I want to get out in 10, 15, 20, or 30, or 50 years, I can get out anytime I want. And I know what the value is on each of those days. Now, I might die in the meantime as well. And if I die, I know what the exit strategy is as well. Because it's going to be a death benefit that's going to be paid to my wife. But if I look at it, I can say with certainty, in 10 years, this is the very least I'm going to get. In 20 years, this is the very least I'm going to get if I get out. What can you say is the very least you're going to get with a mutual fund? What can they guarantee?
Absolutely.
They can guarantee only one thing, and that's 100% loss, right?
Yeah.
That's the only thing they can guarantee. This product, and this is why Wells Fargo, Chase, all the big banks love this product. So when we talk about guarantees, they know at day 7,356 from the day they take it out what the very least is going to be. No other product can give us that. And that's why banks love these things. It gives them the certainty that they can go out and make loans based off of that. And that's really the reason why properly structured whole life insurance, dividend paying from a mutual insurance company is the only product to do, because that's the only product that will give you those guarantees.
Contractual guarantees. It's like how many people would be so much more willing to start a business if they knew in 10, 20 years the exact amount of money that they would have access to or available guaranteed. Yeah. Like that is such a powerful idea. And I love how you phrase that. It took me honestly a little bit of time to wrap my head around it. And as I started thinking about that idea, I was like, that's so incredible, because you're right. What it does is it's saying this is the certainty that everyone is looking for. Here is what's guaranteed to you inside of a contract. It's not hypothetical. It's not theoretical. This is like an actual number that you can get no matter what.
Yeah. And the other side, the part that we haven't talked about yet, and you brought it up, it's contractually guaranteed. The other thing that's contractually guaranteed is our line of credit against it. So this is the power. Again, I'm going to go back. Don't take my word for it. Look at what Wells Fargo does. Look at what Chase does. Look at what all the big banks do, right? This is why they love this contract. Because no matter what's going on, no matter where the insurance company money is being placed, if you ask for a loan against the capital or the cash value of your policy, they are contractually obligated to give you that money. They don't ask you what it's for. They don't say when you're going to pay back. They don't really say anything except for where do you want the check sent to. That's the only question they really ask. Maybe you have to verify who you are. But the point is,
hopefully.
But think about the power of that. I mean, here's a guaranteed asset that I know at the very least is going to be here. Now, what happens with these companies, they said that's the worst case scenario. But we're not the worst case scenario. We're something better than that right now. So therefore, we're going to pay you in the form of a dividend. And so you get a dividend. And then once a dividend is generated and paid, it becomes the new guarantee. So I would even make the point that those guarantees from day one are understated.
Absolutely.
But
because it's
what better position to be in? Again, I'm going to go back and say, would you rather me under-promising and over-performing? Or like our IUL brothers, would you like me to over-promise and underperform? Potentially.
Yes.
Where would you want to be? I want more certainty. Certainty is knowing that I know what the very least is going to be. And if it's more than that, I can celebrate that each and every year. And I will. And it's going to happen because it has happened for 150 years. And think about this. Insurance companies have never missed, at least one in America has never missed a dividend payment for 150 years.
Who wouldn't want to join that business? If you know a
Right.
business has been profitable for over 150 years.
Right. And all you're doing is you're buying into their business. They've invited you into their business. And so you're buying into their business model. And then what they do is they go at an institutional level, manage your money and buy professionally managed bond and real estate portfolio for your benefit at this institutional level. So they're getting deals that none of us as individuals are probably ever going to get. But at the end of the day, it's got the guarantees. It's giving you the contractual guarantee to borrow against it, which no other asset has. You talk about home equity line of credits. That's all fine and dandy until they pull the home equity line of credit because they get nervous.
Well, I think that's actually a really important topic to touch on is because people think, oh, it's a line of credit. And it's yes, but the question is who has the control of that line of credit? And if it's not you, then you are putting yourself in a vulnerable situation.
100% agree. I talk about this in one of my very first podcasts. You go live back and listen to the podcast. This was where I understood completely how the infinite banking concept worked. And it wasn't about dollars or rates of return or anything else. It was about control. Back in 2008, we were trying to do a construction project. On a Thursday, we had the contractor over, said he'd be here next Wednesday to start. On Monday, I got a letter because we were going to fund it with our home equity line of credit. On Monday, we got a letter from the Wells Fargo saying that our line of credit's been pulled. And I call him up and tell him that we weren't able to do that anymore because our line of credit had been pulled. He said that was the third phone call he got this morning. It wasn't me. It was just Wells Fargo got nervous because back in 2008, all the banks were nervous and they pulled everybody's line of credit. And so I'm like, that drove home so importantly how little control you have when other people are saying, if you can do a project, you can't do a project. If you're not the one giving yourselves a thumbs up or thumbs down on those things, then you're not in control.
100%. I think that's such an important thing to consider because it's, okay, what happens if that line of credit were pulled and you had an outstanding balance on it?
Yeah. You still got to pay it back. Your line of credit was gone, the rest of it, but every dollar you paid back, you had no access to it. Unlike your life insurance policy, for every dollar you pay back, you got $1 now that you can borrow again immediately.
Yep. It's the ultimate freedom and control. And I think one of the things that you talk about, and I'm going down the bunny trail here, but when you think about people paying off their homes, because this idea is also very interesting to me, the person that has paid their home off, let's say it's 90%, right? They have 10% left, versus the person who's paid off the home 30%, and let's say they both lose their jobs tomorrow. Who is in a better position? Yeah.
Obviously the person that owes the bank the most.
Yes, because the bank is going to look at those two scenarios and say, the person that has their home paid off the most, we can get the most cash if we sell that. Yep. Versus the person that has the least paid off. And you say this so beautifully. It's like the bank is most vulnerable at the beginning portion of a mortgage, and they're the least vulnerable towards the end.
Yeah.
And that's because they have more control over that equity.
That's exactly right. I mean, who's in control of your equity? Are you in control of it? So people that, again, if we understand banking, we want to get what Nelson called the snakes and dragons out of our lives as soon as possible. But if we have a home, if we own a home and we want to pay it off, I would say fabulous. But let's have a better structure to pay it off. Instead of that extra payment going to the bank, now that controls your money, let's put it in your policy, in your family financing system, your family bank. Let's put it there. And then that way you have control of your equity. You get out 15 years from now or whenever you want to have it paid off, there's nothing saying you can't go ahead and pay it off. But in the meantime, you're the one that has control of the equity. You don't have to ask for permission. You just got to say, send it here. You're telling versus asking.
Yes. And if you have enough money to solve a problem, then you don't have a problem.
Have a problem. Yeah. One of our friends says that quite often.
Yeah, it's so good.
If you have enough money to solve a problem, you don't really have a problem.
You don't really have a problem. It really is that simple. If you stay with cash in your pocket, and like I call my pocket my policies, you're always in a position of power and strength because, like you said, you are the person that can give yourself that permission, yourself that access. And that allows you to take so much more advantage of deals that people don't have access to because they have to go ask for permission for money and then they're losing out on time.
Or they may be told no. That's the scariest part, right?
Yes.
They've given all their their liquid cash away to quote unquote get out of debt. And then when they really need it, now they're like, well, I can just go back in debt. Only if somebody gives you permission to do it. And at the end of the day, if you follow his book and kind of what we teach, put yourself in the position of being the banker. And then that opportunity, the responsibility. At the end of the day, it's all about control. It has nothing more to do than who's in control of the banking function in your life. Do you want to be? And if you're not, then who is? Any closing thoughts or remarks? This has been a fabulous. I get really excited and worked up when we're having this conversation. So
I know. I'm like, closing remarks. I would just say to just be curious. Well, I love that word. Get curious, get educated, get involved in our community, have conversations with me and Wade, and just start down this beautiful path that actually works. Yeah. I think that's so exciting to see people grow along this process. It's one of my favorite things to witness play out in real time.
It is. It's fun to cast those seeds in the ground and then see the field of flowers blossom, isn't it?
Yeah, it's pretty fantastic. So thanks for having me, Wade.
Just real quick for the listeners that, again, want to they might like talking to you more than they like talking to me. And I'm all about abundance. So if you want to have a conversation with Tarisa, if you said, I love your perspective, I love what you're saying, because it's very powerful. And again, I'm genuinely honest when I say that the nuggets that you spread here, that you shared with us, are worth millions of dollars in gold to people. So thank you so much for your time. But if they want to get a hold of you, once again, how do they reach you?
Email is great, or factumfinancial.com. My information is on there, and there's a bunch of great resources for people to have access to. But my email is Tarisa, Tarisa, at Factum, Factum, financial.com.
Factumfinancial.com. And look for Tarisa. She's a rock star, so she loves this industry, loves this business, and she's doing exactly what needs to be done to take control of that banking function in our lives. And really, more importantly, teaching others and helping others, empowering others, I think is probably the best way to look at it, to do that in their own lives. So again, thank you so much for your time. I look forward to future conversations because I know there's going to be many more as we go along. So thank you for the 4-part series. I know we had a lot to say. There's a number of different podcasts, but I would just encourage people to go back and listen to them. And then if you find good nuggets, share it with people, right? Share it with those that you love, that think can be impacted by what we had to say here. And just because people are saying, no, I don't necessarily want to listen to it, share it with them again later on once you listen to it the second or third time, because no today doesn't mean no forever. If you really want to make an impact in other people's lives, I think this idea, this thought process that we're sharing with people can make that huge impact on people's lives.
Thanks, Wade. You made my day.
Likewise.
If you're enjoying this podcast or know anyone else that might be interested, please be sure to hit the subscribe button and please leave a review. This will help this podcast reach and help more people by ranking higher in searches and ultimately help more people get out of financial bondage. And don't be afraid to share this podcast with your friends and family. that we can be easily found on Apple Podcasts and Spotify.